What's going on, y'all? Welcome to another edition of Weeds Weekly, where I, Kevin, just walk you through what happened this past week with regards to data, with regards to interest rates, and we touch a little bit on real estate. I'm also going to talk about this upcoming week. Yes, I get it's Tuesday. I went to an after party show for ACL on Sunday night, got slightly overserved, had some company yesterday, so I am coming to you a day late and a dollar short. So I do apologize, but trust me, it was worth it. Also, I'm going to touch on a couple different topics as well. Number one, not the best strategy. And what am I talking about there? I'm talking about what do you do with your seller concessions today? And then lastly, we're going to talk about back to the future. I'm always trying to think of clever ways to help us get clients off the fence. So I thought that, hey, as I say it all the time, numbers don't lie. So we're gonna get into what do I mean by that. So let's just dive into what happened last week. And again, we were blown away, right? That non-farm payrolls number, all eyes were on the labor market. We've been talking now about it for, I'd say, a couple months. Inflation kind of went to the back burner as far as the Fed's hot topic. In the labor market, jobs became the number one topic that the Fed was focused on. We were looking at a forecast, I think, of about 141,000, which is nothing. And that number was blown away by over 100,000, approximately, new jobs that were added. So what did it do? It did exactly what we thought it would do. It moved the market, and it moved it not in our favor. Again, and the real logic is the following. On September 18th, everyone was really excited that we got that half a point cut. And what it did is it instilled some inflation fears back into the bond market, right? So you had a lot of traders like, I don't know, and it kind of pushed rates up slightly. Well, now if the labor market is fairly stable and it doesn't look like it looks like we're going to avert a recession, right? So instead of being pessimistic and being negative on the economy and where it's going, and it looks like it's kind of treading on thin water. Now it looks like we have a very optimistic outlook. It looks like the Fed may have achieved this soft landing. It looks like the labor market is not struggling like we thought from a few months ago with that non-farm payroll, and it looks to be fairly stable. So you now have inflation, which seems to be coming down closer and closer and closer every month toward that Fed funds rate target of 2%. And now you have the stabilization of the labor market. And you also have GDP that's looking pretty good. So what does that mean? It just means that it doesn't look like the Fed needs to do anything drastic. They may pause come November 7th. That's my prediction. They are not going to give us another rate cut. I don't see any reason why they would, right? It looks to be a stabilized market at the moment. They should allow that half a point reduction to adjust, sink into the market, and see if it does cause any inflationary measures. They should just pause, in my opinion. However, what it does also from a trader's perspective, right, they're always forward thinking. So on September 18th, the Fed released that dot plot that gives you the outline of where they believe that the Fed funds rate's gonna be. Well, given the labor market and given those numbers, it looks like that's already been skewed. So although that just came out on September 18th, we won't get the next one until December. How did it change? And again, traders are anticipating how they think it changed. They're anticipating at what point are we going to get reductions now to the Fed funds rate, and when will interest rates be coming down? So they're gambling, saying, well, that outlook doesn't look like it's going to be as quick given all the good recent economic data that we're seeing and the stabilization. So that looks like that's going to be pushed down the road. So we'll talk a little bit more about that in a little bit. But that's really what happened. So the result has been, hey, we're at the highest rates that we've seen now in the past 2 months. So everyone that thought they had the ability to predict the market, and I had some clients that paused on a potential refinance. I had some clients that tried to pick interest rates as far as guess that they were going to be coming down for purchases. So they wanted to pause. They thought that they might get a little bit lower. What we can see now is we need to pounce on those lows. I say it all the time, right? The market is still evolving. We do not have a direct trajectory of the way it's going, although I think over a 2-3 year span now, we do. However, we're still a couple years to where we're going to see those rates come all the way down into that 5% range, and I'll touch on that later as well. The other thing I want to talk about really quick is a crisis was averted. What that with the docksmen and stuff like that, and the ports that they were anticipating they were going to close. And they somewhat have kicked the can down the road. They said, okay, well, we'll worry about AI, we'll worry about automation. All that's on the table. We're going to agree to over a 60% increase over the next 6 years. I would love to see that. I wish we were all getting that as well. So, but my point is this: what was alarming to me, and I hope that the next president and the next cabinet and whoever, Congress, they actually sit down and look at this. The ability of 45,000 workers to basically bring the economy to a screeching halt, essentially, cause inflation, cause prices to go up, and so on. That just does not sound right. That doesn't sound like that's something that we want to entertain in the future. I'm not against unions. I don't care. What I care about is the American people, and the ability of 45,000 people to be able to do that and cause that type of harm to an overall U.S. economy. Man, that's got to change. I don't see why we would want to continue down that path. So now let's jump ahead what we can expect this week. And like I said, it's already Tuesday, so my apologies about getting to you a day late, but it was with a good cause. Did that after party for Don Dalla on Sunday night, and it was a blast. Didn't get into about 2, 3 in the morning, but highly recommended. So anyway, this week, I think the biggest thing that all the traders are going to look at is we have over 15 Fed members that are actually going to be speaking this week. And given the non-farm payroll numbers of last week, how does their vernacular change? What can be said where a trader's going to say and the market's going to perceive, okay, now we understand what we believe is going to be changed to the dot plot, when we think reductions to the Fed funds rates are going to happen, how that's been affected, and so on and so forth. I think you're going to see a lot of people hinging on that, and they speak every day this week. So it's not something that's just going to happen overnight. It's something that's going to progress throughout the week. So I think that's the biggest thing to watch this week is what do they say, who says it, when did they say it, how does that get digested? The other thing is, it is the week of inflation. We have CPI and PPI this week, but look, that's been under control now for quite some time. I don't think already we may see, the policy change of the Fed where they come out and they reduce that Fed funds rate by 0.5 point. The markets initially perceived that it could be an inflationary because it could create more cash flow in the economy. That's not going to come through in this month. It's not going to come through in these numbers. These numbers are going to be fine. They're going to either be right in line or we're going to see that 0.1% reduction that we've been seeing for the last 6 months now. It's just been this slow drip of inflation coming back down and so on and so forth towards that target rate of 2% for the Fed. So I don't see any surprises there. So I don't think it's a big concern, although it's going to be something that obviously we're going to want to make sure if it does come in and it's way out of bounds, why I think the market would treat it as a one-off. So I think the biggest thing to watch this week is going to be those Fed members speaking that could move the market. So now let's talk about what's not the best strategy moving forward anymore. So for a lot of this year, and particularly towards the end of last year, a lot of what we talked about were buydowns. We were talking 3-2-1 buydowns. We were talking 2-1 buydowns. We were talking about just buying down the interest rate. And all these builders were doing it, and you had these seller concessions. And what I'm saying is now that we're in this rate reduction area, that is no longer a good strategy. I think it's actually a poor strategy, actually, because there's no doubt about it that well over the next, I'd say 6 months, year, well within your 2-year time frame, if you were to be closing in the next 30 days, 60 days, the remainder of, let's say, 2024, the ability for you to refinance going forward in the future is going to be there. So there's no reason for you to be using those seller concessions to be paying down that interest rate. It simply doesn't make sense. So 4 things that I think you should be using that money for. And again, I think we as agents should be asking for seller concessions on every deal that we're still writing, right? The market is still going through a flux. Sellers are still willing to negotiate, and depending on obviously your market, but it's for a great majority of the markets out there, please be writing offers with those seller concessions. But what would you use it for? Number one, you want to make sure that all your closing costs are paid for, or your title fees, processing, underwriting, everything like that. You want to make sure that all those closing costs are paid for. And the reason you want to do that is because you don't want to have to pay them again, right? you're going to be potentially refinancing, so you don't want to pay them now and then pay them again in the future with money out of your pocket. What you want to do is eventually try to potentially guess or make your best analysis of when the rates have bottomed. And at that point, you want to pay those closing costs. So you want to make sure that your closing costs are paid for. That's number one. Number two, every lender requires that your home insurance policy on a purchase is paid a year in advance. So that's 12 months. So whatever that policy is, you want to make sure that that gets paid for, right? We're trying to eliminate money out of your pocket. We don't need to buy down rates anymore because the rates will be lower in the future and we'll refinance that. So we'll secure that. I'm going to talk about that next, but we want to make sure that it's the least amount of money out of your pocket. We would love to get it to where you're just showing up with your down payment and that's it. And I'm doing that on a lot of closings these days. The third thing, you want to fund an escrow account. I get it. You may want to pay your own taxes and insurance. You may have never had an escrow account, and that's okay. You really don't need to have one. But given the 3% seller concessions, and if there's money sitting there, you want to have an escrow account because you can use those seller concessions to fund that escrow account. And here's the kicker. If you don't want one and you have put down 20% at that closing table, within 3 or 6 months, you can call your lender and you can request to not have an escrow account and they will cut you a check within 30 days and send all that money back to you. But you want to actually set up an escrow at closing so that you use the 3% effectively and fund that with the seller concessions. So once again, it's not money out of your pocket. And then the last thing I would do is if there was still money left over, I would be doing a reduction to the purchase price. For every $1,000 that you're borrowing today at a rate of approximately 6.5%, it's about $6.32 a month for the next 30 years. Now I get it's not a lot of money. If you're talking a $5,000 reduction, it's like 31 bucks, but money's money. As I tell everybody, if you don't want the $31, you can send me that check every month. I will gladly take the money. So I would do an addendum to the purchase contract and I would be reducing my purchase price. And again, it's okay that you're already under contract. If you're not utilizing that 3%, the seller should have no problem making that reduction because again, it's just money that's coming to you. You would then lower the seller concessions a little bit and you would use that money to bring that purchase price down. And that's something that you're gonna walk through your lender with. I do it all the time with clients. Run numbers till I'm blue in the face because numbers don't lie. Which brings me to my last point, and I called it back to the future. I'm always, this is one of my favorite things that I always try to come up with every week is how can I help agents, the agents that I have, as well as anybody that's listening to this, how can we get our clients off the fence? How can we get thinking outside the box so we can get some movement in somewhat of a stagnant market depending on where you're at? And I love the adage, once again, that numbers don't lie. So the big thing that I see all the time, and I just had a conversation with a couple of clients over the weekend, and how I was able to get them off the fence. I actually got one client that said, yeah, that makes a lot of sense. And I got a client I'm going to be following up with today with regards to this is, I don't want to talk about today's payments. I want to talk about the future payments. I think we can all sit here and agree that within, I'd say by the end of 2026, we are going to see interest rates at least drop another percentage point to 1.5, right? Because you have to remember, the Fed funds rate, where the Fed is actually setting policy, they want that to be as close to inflation as possible. So if their objective is to get inflation down to 2%, then their objective is also then to get the Fed funds rate down to 2%. And right now it's sitting at 4.75 to 5%. Well, that's a big swing that is going to be coming down. Now, you have the overlays and everything else, and you have some pricing that lays into that. But my point is this: I'd say by 2026, I think it's safe to say, especially with a stabilizing economy, that the Fed is going to be able to bring that Fed funds rate much closer to inflation. So I no longer want to talk about what's today's payment. I want to talk about what the payment's going to be in the future, because right now there is a plethora, an abundance of inventory, especially in some markets, where you're going to be able to go out and find some great houses. You also have sellers willing to negotiate, which means that you might be able to get a house much lower than you would have potentially in the future be able to get that house for. And the house of your dreams could be sitting out there where in about maybe 6 months to a year, once those interest rates start to come down, it's not going to be there. So I'm no longer talking about what is your payment today. I'm talking about what your payment's going to be. So just an example, and you're going to see this in the email, so I don't want to dive into it too much because you're going to be able to see the raw numbers, but just take a loan amount of $250,000. I did a rate today of 6.5%. That payment's $1,580.17. Well, by 2026, or by the end of 2026, which is about 2 years out, it looks like I think you could get down to about 5%. That's a 1.5 reduction in that interest rate. I believe, strongly believe that that's where interest rates will be, if not slightly lower, but I think they're going to be right around there. You're looking at $238 a month off that number. So now you're looking at $1,342. Jump up to $1 million. 63,2068 turns into 53,6822, a $950 a month savings. I don't want to talk about that $6,300 bucks. I want to talk about the 53,68. That's where you're going to be in just 2 short years. And now you jump up to $2 million, you're talking $1,904 a month cheaper than where it is today. So again, I just go back to where we're trying to really be professionals with our clients. We're really trying to help them understand where the market's going, looking at the future, game planning for what's coming ahead, and stop being so enamored with what's happening today and the media and everything else, and help our clients get over that hump of don't think about today. Let's talk about the future and where things are going, and having the house of your dreams and having a payment that's $1,900 a month less. So once again, just trying to brainstorm, come up with ideas, help you think outside the box. All right, I hope you have a great week. I hope this was helpful. I love coming to you every week. If you need anything, text, email, pick up the phone and give me a call. You want to grab a coffee, talk about the market while we're still kind of in this flux period back and forth. Talk about marketing ideas. Talk about potential flyers we could put together. I'm your guy. Talk about a client scenario. Once again, I'm your guy. I love numbers. I love talking about them till I'm blue in the face. Happy selling out there. Have a great week. I'll be talking to you on Friday with my Friday wrap up. As always, enjoy the rest of your week. Happy selling out there, and I will talk to you soon. Cheers.